All right, you watched the first video and 6 months have passed, right? And so now you're ready to get a home. So let's get you into a home. So here's part 2. We're going to be talking about mortgages and how to get pre-approved for a mortgage. So again, if you found that the content was helpful in part 1 of this series, now this is part 2, and you like this content, again, feel free to like and subscribe to the channel. I will be making plenty of videos on this subject matter and on other subjects in areas of which I have some sort of expertise. And so your support would be greatly appreciated. But aside from that, let's go ahead and dive right on into it. So if you are watching this video for the first time and you haven't watched part 1 and you are in a position where you need to improve your credit score to get approved for a home loan, I would strongly recommend part 1. If you haven't watched it and you're in a good position credit-wise, it's perfectly fine if you skip that. I do believe that the content was helpful, so you might want to check that out at some time. But otherwise, this is the place to be. So the first thing I want to address is that a lot of the things I'm going to be talking about in this video are according to Fannie Mae and Freddie Mac guidelines. And so what does that mean? That means that there are certain standards that are required by Fannie Mae and Freddie Mac for their loans, for conventional loans that don't necessarily apply to other loans. There are other options, and there are a variety of other options, but to start out, I want to talk about Fannie Mae and Freddie Mac guidelines and then build from there. So the first thing I want to talk about is your debt to income ratio. And so what is that? Short for DTI. Your debt to income ratio is your total debts. So including the house that you're going to be purchasing, your principal, interest, taxes, and insurance, all of that being your mortgage payment. And then other debts. So do you have credit card debts? Do you have a car loan? Do you have any other kind of debt that would show up on your credit report? That would all be encompassed as under one umbrella as your debt. And then what is your income? So let's just say, for example, that you make $60,000. What you are going to want for a debt to income ratio is something under 36%, again, according to Fannie Mae and Freddie Mac guidelines. So if you were making $60,000 a year or $5,000 a month, you would want your total debts to be under $1,800 according to Fannie Mae or Freddie Mac guidelines. And so that is an important metric to keep in mind, 36%. Now I want to share with you an insider secret, and that it's actually a higher percentage than that. And so that is what you'll see if you follow Fannie Mae or Freddie Mac guidelines. If you go to their website, you would see this percentage, 36%. But we can work, if you're a little bit higher than that, we can work up to 45% of your income for your debts. And so just keep that in mind, that the general principle is that you're going to want to have a 36% debt to income ratio. I think that's just wise in general, but we have been able to approve loans for up to 45% debt to income ratio, again, for Fannie Mae or Freddie Mac loan. Now, the next thing we need to address is your employment history. Are you self-employed or are you W-2'd? If you're W-2'd, what you're going to need is 1 year of employment history in the same field. So if you switched jobs in the last year, but you're in the same field, that's okay. But if you completely change fields, you're going to need a 1 year employment history within that field to get approved, again, for a Fannie Mae or Freddie Mac loan. And you'll see why I'm emphasizing those things when we get to later in the video, where we'll address several different exceptions. All right, so we have our debt to income, we have our employment history. The next big thing for Fannie Mae, Freddie Mac guidelines is the loan to value. So in other words, how much of a down payment are you putting? For the traditional conventional loans, the thing that they're going to be looking for is that you're going to be putting a 20% down payment. So a house that's selling for $300,000, that you would put at least $60,000 down. Now, I wouldn't recommend this for a variety of reasons. You can use those $60,000 or at least, I don't know, $50,000 of that investment, of that down payment, and invest it and get a greater return, especially with mortgage rates being so low as they are right now. But again, just for conventional purposes, just assume that you're going to need to put 20% down on a home loan. Now, if you're going from a position where you went from bad credit or no credit to good credit, you have a 670 credit score, or the minimum credit score for a Fannie Mae Freddie Mac loan is 620, then my guess is that you're also in a position where you're not able to put something like $60,000 down on a $300,000 home. With that being said, again, wait till the end of the video. There are plenty of options, but just for beginners terms, let's think of this as an 80% loan to value ratio. So you're getting a loan on a $300,000 home for $240,000 and you're putting $60,000 down. Now, the next thing you're going to want to consider is, where do you go for a mortgage lender? Now, there are a variety of options here. I used to work in California for a mortgage lender that had about 1,000 employees, and I had licenses in several different states. I think it was something like 8 different states: California, Indiana, South Dakota, North Carolina, et cetera, et cetera. And there are some advantages to working with lenders like that. If you have big loans, if you're W-2'd, if you're not self-employed, then those options will be quite attractive. If you're getting, you're putting a lot of money down on your home, then one of those big box ones, you might actually not have to pay any fees. They'll actually pay for your appraisal. But if you're pursuing a smaller loan on a home, there are much more attractive options locally. I would suggest checking out a credit union, a local bank. There were so many different things that were available at these lenders that I wouldn't have dreamed of being able to offer working for the big box retail mortgage agency that I worked for. And so let me give you some examples of those. First of all, Regions Bank. Now, if you're anywhere near in the vicinity of a Regions Bank and you are a first-time home buyer, they have some very attractive options for you that don't involve Fannie Mae or Freddie Mac. So why would they not involve Fannie Mae and Freddie Mac? Well, it's because they're using their own money. These are in-house loans. And so because they are using their own money to make a loan, they don't have to follow any guidelines. They can make their own guidelines. And so I've seen very attractive options for first-time home buyers at regular rates without any mortgage insurance at 97% loan to value. So you only have to put a 3% down payment. At 99%, you only have to put a 1% down payment. I've seen those things. And so smaller banks will often have attractive options. Credit unions often have attractive options. Now, let me describe my own situation. When I first bought a house, I was self-employed and I only had 1 year of experience in my field. For self-employed people, you need 2 years of experience in your self-employment field. I only had 1 year of experience. I would not have qualified for a Fannie Mae or Freddie Mac loan. And so I went to a local credit union, and actually I got a referral for a local credit union. They looked at my financials, they saw that everything was fine, and so they were willing to make me a loan, again, with their own money. And so, again, any of these big box retailers, retail mortgage lenders, they're not going to offer these things to you. They're only going to operate by Fannie Mae or Freddie Mac guidelines. But then if you pursue something around you, I would definitely recommend checking out a credit union, a small bank, not necessarily Chase or Bank of America, something like that, but a smaller bank. You may find some attractive deals. All right, and here's what you want. You've got your debt to income in a good position. You have your 1 year employment history for if you're W-2'd, or 2 year employment history if you are self-employed like me. You've got your loan to value into consideration, and you've found the correct mortgage lender. Here's the next thing you need. You need to approach them and you need to get a pre-approval letter. This letter is key in working with a realtor and in finding the right house for you. So approach them, give them all your documentation, your W-2s, your tax returns, your bank stubs. They need to see a few other things just to make sure that they would pre-approve you or qualify you for a loan. And you get that letter. Now you are ready to buy a house. And here's where the fun part begins. But I will cover that in part 3 of this series. So stay tuned.